Hi, Barb Reberg here, former portfolio manager, university investments instructor, here to talk to you about high yield investing. Got a call from a family member last week. Well, actually, it wasn't a call because who calls anymore? It was a text. And he said to me, I found this investment. It's a closed end fund. They've been paying 10, 12% a year for many years. Is it worth it? Is it a scam? And once I got that question, I had to go down the rabbit hole of explaining how you get a high yield, what the trade offs are, where you can get cash flow, and what kind of yield is reasonable. And then I created this whole document for him. And I wanted to share it with you because this is a nugget of how you can evaluate and understand the type of returns that you might see promised on certain investments. So let's dive in. If you're looking for high yield investments with cash flow, look, you can get a high yield cash account today in, the end of 2024 that pays you about 4% per year. You can get that with high yield bank account, a money market fund, mutual fund, or a CD, eBank CD. You might even get a little more. High dividend stock funds, they give you cash flow. High yield corporate bonds. If you're willing to go along the risk ladder, you might even get higher than 4 or 5% on a high yield corporate bond fund. But let's get down to how you know whether this is stable, it will last, and is it reasonable to expect, and what you have to give up, because there is no free lunch. And whenever you go higher on the risk ladder, you have to pay. I'm sorry, scratch that. Whenever you go higher on the return ladder, you have to pay a price for those higher returns. And that is the willingness to take on more risk. And what does more risk mean? In real terms, more risk means the ability to withstand potential losses. So let's get into the basics so you know how to compare your returns and how to understand them. The average returns on a fixed income investment like a corporate bond or a intermediate term bond is roughly 5%. So if you invest $100 in a corporate bond, you will get $5 interest payment per year. That's to be expected, and the principal value of that bond will stay relatively stable. So at the end of the term of that bond, you can expect to get your $100 back, and for every year, you'll have received $5. Easy to understand. Is that a windfall? No, but it might be enough to keep up with inflation. It's certainly not 10 or 12% a year. So if you're getting more than 5% per year, and if you want to learn more about historical stock and bond returns, I'll put a link to this article, which is highlighted below, which tells you the history of what type of returns you can expect on different investments. Now on to 3. With a higher yielding investment, you have a higher possibility of loss. That's what I said before. And why is that? Because the investment has to offer a higher return in order for you to invest, to entice you to invest in a riskier asset. So you have to understand the risks and the rewards of investing. And that is why this 10% fund stood out, because you're talking about a 5% premium over what you would expect on a typical fixed income fund that is sustainable over the long term. Now, the investment that my family member put forth was a closed-end fund. It's similar to a mutual fund or an exchange-traded fund, except that the investments within that fund are stagnant. They don't change. They change very infrequently. And many times closed-end funds can sell at quite a nice discount, which means you might have a fund in which the underlying investments are worth $100, but you can buy that fund for $95, which means you've automatically made a $5 premium. And that makes closed-end funds appealing at some times. On the flip side, many of them charge higher expense ratios, management fees as a percent of the investment. So that immediately takes away from your total return. But when you are looking at a fund, like the one that was presented to me, there are a couple of questions you have to ask yourself. You can't just say, wow, 10%, 12%, I'm in, I'm buying it. Because you have to understand what are the underlying assets or investments within the fund, because that will determine the return. Are they stocks? Are they bonds? Are there special strategies? Are they high yields, high large cap stocks, high yield, corporate bonds, government bonds. And when we get into the analysis of this particular investment that my family member sent to me, then you'll understand why it's so important to know what you're investing in. The bond fund is going to behave differently than a stock fund. And then you have to look at it and go, okay, let's look at the return that you're getting today. Is that sustainable? If you're getting a 10 or 12% return today, can the fund keep that up in the future? And that is the key, because I'm going to tell you a story. I invested in a closed-end fund probably 20, 30 years ago. It was paying like 12%. And this was before I knew what I'm telling you today, this valuable information. And I was like, 12%? Great. How can you lose? Well, I lost because the underlying investment in that fund were airplane leases. And due to the leases, we got a percentage of those lease payments, and that enabled the fund to pay out 10, 12% a year. But what happened over time, the business didn't do so well, and they had trouble. The airplanes got older, and so they couldn't lease them for the same amount, and the value of those airplane leases declined. And so the value of the investment declined, and it actually declined 75%. So I sold that fund with a 75% loss. That's when an investment goes south. And that is why you do not want to get super excited when you see a high yield investment. You have to look under the hood and what is that fund invested in? Okay, so let's go to bond funds. They have a really good promise today because as interest rates decline, a bond fund by its nature will increase in value. And so even if your coupon payments or the interest payments from the bonds decline a little, the overall value of the underlying bonds is going to increase. So a bond fund is not a bad investment for today. And if you go in a high yield bond fund investment, you could get 7 or 8% return, not 10 or 12. And the return should be pretty stable, as today in October, November 2024, interest rates are going to decline. Now, as a side note, if you're looking at this video at another time when interest rates are rising, understand that your bond fund value will decline as interest rates rise. That is just the nature of bonds and bond funds. Now let's get into stocks. Investing in, let's say, a high yield stock fund. It's really important to understand the valuation of stock. And one of the barometers that we use in understanding stock valuation is what's called a price earnings ratio. We're using a special type, which is the Shiller price earnings ratio. And it's based on the earnings from the last 10 years divided by the price of the stock or the stock fund today. And that gives you a number. And what it represents, like today, the current Shiller PE ratio on the S&P 500 is 37.15. That means you're paying $37 and change to buy $1 of earnings in the S&P 500. That sounds like a lot, yeah? Because it is a lot. The average Shiller PE ratio is 17%. So what that means is if you're buying a stock fund today, a high yield stock fund with high dividends, stocks tend to revert to their mean value. And if we're using this measure, the Shiller PE ratio, stocks are about 50% overvalued today. So likelihood is that, yeah, the dividend payment could stay fixed. It could decline, but there is a great likelihood that the price of your stock or your stock fund will decline going forward. Now, maybe not this year, next year, but over the next 10 years or so, yeah, it's going to revert to its mean. So that is a risk you're taking with a high yield stock fund today. We're going to pull this all together at the end, so just hang there with me. You're looking at a graph of the Shiller PE fund, Shiller PE of the Standard & Poor's. And you'll see historically, this is where it's at today. This is not the highest level, but clearly this is not the lowest level. Now, if you invested here when the Shiller PE ratio was lower, you'll see you will have gotten higher returns as the PE ratio has gone up. So, as we said, in the intermediate term, it's more likely than not that you're going to find either earnings are going to catapult, which will make the Shiller PE ratio revert to the mean, and or stock prices will fall, which will again revert the Shiller PE back to a mean level. The takeaway, very simple. In the intermediate term, expect that your stocks and stock funds are going to have a pullback at some point. Now, we told you my story. Now, here is the investment that was presented to me. It is the Liberty All-Star Growth Closed Fund. Now, I have no horse in this race. I don't own the fund. I don't want to say you should buy it, you shouldn't buy it. That's up to you. But let me help you understand why this growth fund has delivered wonderful returns over the past period of time. It is a closed-end fund that is invested in 3 different other underlying funds. Okay, 1 large cap stock fund, 1 mid cap stock fund, 1 small cap stock fund. Currently, it's selling at a discount of 5.49%. It has an expense ratio of 1.13. It owns growth companies. So this is a stock fund. But here's why you got such an amazing return of 10 to 12% on this fund, and why I am skeptical as to whether this will continue to pay out. The current policy is to pay distributions of approximately 8% of its net asset value per year. What does that mean in plain English? Let's say the value of the stocks in the funds are $100. Let's say maybe they have a dividend of, a combined dividend of maybe 2%. You'll get the dividend payment, and they will sell 8% of the fund's assets, or the 3 funds within this closed end, what we call it, maybe a fund of funds or an umbrella fund. So they are selling 8% of the shares. So it's like, let's say you own ABC stock, it's worth $100, and you sell 8% of it. So then you have 92% left. Well, if the stock continues to go up, then great. The next year you sell 8%, and the value, you figure if it goes up 8%, then you're still even. If it goes up more, then the value of the actual fund will go up. And that is how this investment over the prior few years has been able to deliver such high returns. They're selling part of the underlying fund's principal off. And when the stock market is going up exponentially, like it has been, well, then there's no problem. But let's take a contrarian viewpoint. Let's say the stock that is owned within this fund declines, and they're still paying 8% out per year. Well, then, yeah, you might be getting your 10 or 12% return. But instead of your initial investment being worth $100, it's going to be worth 88, 90%, 80% if the stock goes down in the future. And that gets back to what we were talking about before, which is the stock market is overvalued today. The likelihood is that stock prices will decline in the future. And so, if you have a fund that owns a lot of individual stocks and it is paying out part of the principal, you've got a good chance that over the next, 5, 10, the principal value of this fund is going to go down if the stock market goes down. It's unsustainable. Now, if it's just paying out dividends, that's a whole nother story, because even if the underlying stocks decline a little, it's not going to decline the fund will not decline as much. If they're just paying out dividends, it'll decline less because they're not giving you also a portion of the fund's principal. I'm going to give you one more example before we tie this all up. And this is another example of a higher yield investment. This is called a high yield bond investment. And this is actually more common than the Liberty All-Star Growth Fund that we went through before. This because this is a bond fund, and a lot of people like to invest in high yield bond funds. And what you'll see is this is giving a 6.87% 12-month yield. It's a tad over the average of 5% bond yields. And the reason is they are investing in lower credit quality bonds. Now, as we said before, when interest rates are falling, bond values typically rise. So, with this fund in particular, we know it owns shares in a variety of lower credit quality bonds. There are many bonds within this fund, and what you will understand is when one bond comes due, they will reinvest in another bond. Now, when interest rates are declining, you're going to expect that the yield on the new bonds they invest in will be a little lower. So the yield you're going to expect next year might be a little lower than this. But unlike the stock fund, the actual price of this fund, the underlying bond values, is likely to go up. And this happens to be, and again, not recommending it, this happens to be a managed fund, which means the managers are pretty smart. iShares is a pretty decent company. They're going to look for ways to keep the yield relatively high while maximizing the capital appreciation in the fund. And let's get down to one more thing. The expense ratio is only 35 basis points, which means 0.35%, which is relatively low in contrast with this stock fund that has an expense ratio of 1.3%. Investing thoughts for high yield cash flow wrap up. Higher yielding assets typically involve the possibility of greater risk or loss. Now, that doesn't mean you're definitely going to lose money, because then why would you even invest? Obviously. But there is that possibility. So be aware of that. They have to pay you a higher yield if you're investing in a riskier investment or one that involves lower credit quality assets. Understand where your return is coming from. What kind of fund are you investing in? Is it a high yield stock dividend fund? Is it a dividend aristocrat fund, which is a stock fund that chooses companies that have raised their dividend over many years? And that way you can expect that the dividends will increase. Is the return from bond coupon or interest payments? Or does it include actual principal payments, like one of the investments we discussed before? Now, this part's not fun. Read the investment prospectus and understand the risks. They have a section in the prospectus that says risks. Doesn't mean they're going to happen, but they have to let you know. Understand current asset valuations, because over the long haul, assets typically return to their mean or average valuation. I use a price earnings ratio to measure that valuation. It's a simple ratio. You can get that for almost every asset that you invest in. When investing in bonds, bond values typically decline when interest rates are going up. And why is that? Well, because you can buy a new bond with a higher coupon or interest payment in a rising interest rate environment. So why would you pay the same amount for a bond with a lower interest rate? And that's why the value of bonds, when interest rates are rising, typically declines. On the contrary, when interest rates are falling, like they are doing now at the end of 2024, bond values typically increase. And newly issued bonds will typically pay lower interest or coupon payments, but the value of your existing bonds are going to go up. Now, if you just want stability and a little bit of a higher yield than you'll get on your checking account or your typical bank savings account, you can invest in individual bonds. If you hold them until maturity, you will likely get your principal back, and during the interim, you will receive usually semi-annual coupon payments, which is the interest rate, and it's determined when the bond is issued. You can invest in CDs or certificates of deposit for certain terms, 6 months, year, 2 year, 3 years, and you will get the value of that certificate deposit back at maturity, and along the way, you'll receive the stated yield or interest payment. Now, high yield cash accounts, your principal will be secure, but as interest rates rise or fall, the amount of your interest payment will change along with the going market interest rates. So if you like this video, please give it a thumbs up, subscribe to my channel. If you click on any links that happen to say affiliate at the bottom, our company might get a small payment. You'll have some helpful articles and resources in the description box below, including links to high yield cash accounts, as well as links to related articles. And as a disclosure, I am invested in the iShares High Yield Systematic Bond Index Fund, HYDB, that we were discussing in this video. See you next time. Bye.